The hook and intro. The silent erosion of the American dream. Hey everyone, I'm Bogdan. I want you to close your eyes for a second and imagine a scenario that I guarantee nearly every single one of you has experienced in the last few years. You drive to the gas station and you look at the price per gallon. It used to be $3, now it's $5. You go to the grocery store and you pick up a carton of eggs, a loaf of bread, maybe a pound of ground beef. The total at the register hits you like a shockwave. It's significantly higher than last month. You tell yourself it's just temporary. It's just a rough patch, but here's the cold, hard reality that I need you to understand. This isn't just a rough patch. This isn't just a temporary inconvenience. This is inflation, and it is the single most dangerous, insidious force working against the average American right now. It's not loud. It doesn't arrive with a dramatic bang like a stock market crash or a bank run. It works silently, invisibly, like a slow leak in the foundation of your financial house. You look at your savings account balance, maybe you have $50,000, maybe $500,000, and the number looks exactly the same as it did a year ago. Maybe it even went up slightly with interest, but what if I told you that in reality, you are significantly poorer than you were before simply because of that slow, silent erosion? Here's the shocking question that I want you to wrestle with. What if I told you that every single dollar you keep in a standard savings account, earning 0.5% or even 1% interest, is fundamentally losing value every single day, and that the American dream that your parents and grandparents worked for, the idea that you could save money, buy a home, and secure a comfortable retirement, is being systematically destroyed by a force you can't even see? That, my friends, is the topic we are tackling today. Inflation is the silent killer of the American dream, and if you don't understand how to fight back, you risk losing everything you've worked for. Look, the American financial system operates on a set of assumptions. One of the biggest assumptions is that money holds its value. But history, macroeconomic data, and current events all tell a different story. In an inflationary environment, holding cash is a losing proposition. It's like standing on a treadmill that keeps accelerating. You have to run faster and faster just to stay in the exact same spot. For decades, Americans were taught to save, to put money away for a rainy day. But when inflation runs hot, a rainy day fund becomes a melting ice cube. The goal of this video is not to panic you. The goal is to inform you, to empower you, and to give you the strategies that Wall Street insiders, global investors, and high-net-worth individuals use to protect their wealth during periods of high inflation. We are going to break down complex concepts into actionable strategies. First, we need to understand exactly what inflation is beyond just higher prices. We need to look at the Federal Reserve's role because they are the central bank that holds the levers of this entire economy. We need to understand the difference between good inflation hedges and bad inflation hedges. We're going to look at real estate, gold, cryptocurrency, and the stock market, and I'll show you why simply buying an index fund isn't enough in this environment. We're going to dive deep into historical data from the 1970s stagflation crisis to see exactly what worked and what didn't work. We're also going to look at the current geopolitical landscape and understand why supply chain issues and energy shocks continue to keep prices elevated and what that means for your portfolio. This isn't just about making money, it's about preserving a lifestyle. It's about ensuring that your hard-earned savings retain their purchasing power so that when you finally retire, you can actually afford to live the life you planned. The stakes are high, the global economy is shifting, and the rules are changing faster than ever before. If you think the current situation is temporary, I'm afraid you may be in for a rude awakening. But if you are proactive, if you understand the forces at play, you can not only survive this inflationary period but potentially thrive during it. So, buckle up. This is going to be a deep dive. Get ready to rethink everything you thought you knew about saving money. The Deep Dive Body Protecting Your Wealth from Erosion Chapter 1. The Anatomy of Inflation, the twin engines of price pressure. Before we can protect ourselves from inflation, we must understand exactly what it is and where it comes from. The official definition, provided by institutions like the Bureau of Labor Statistics, is straightforward. Inflation is the decline of purchasing power of a given currency over time. The quantitative estimate of the rate at which the decline in purchasing power occurs can be reflected in the increase of an average price level of a basket of selected goods and services in an economy over some period of time. In the U.S., the most commonly cited measure is the Consumer Price Index (CPI). The CPI attempts to track the prices of a representative basket of goods and services that a typical urban consumer purchases. This basket includes everything from food and energy to rent, medical care, and transportation. When the CPI rises, we say inflation is present. However, inflation is not a monolithic force. It typically arises from two distinct mechanisms, which we can call the twin engines of price pressure: demand-pull inflation and cost-push inflation. Understanding these two concepts is crucial because they demand different responses in your personal financial strategy. Demand-pull inflation: too many dollars chasing too few goods. Demand-pull inflation occurs when aggregate demand in an economy outpaces aggregate supply. Think of it like an auction. If everyone wants the same item, but there are only a limited number of items available, the price will naturally increase as people bid against each other. In a macroeconomic sense, demand-pull inflation happens when consumers have more money to spend than the economy can produce in goods and services. This phenomenon was a primary driver of the inflation we saw following the COVID-19 pandemic. The U.S. government implemented massive fiscal stimulus packages, including stimulus checks, enhanced unemployment benefits, and forgivable loans. This injected trillions of dollars directly into the hands of consumers. Simultaneously, interest rates were kept near zero by the Federal Reserve, making borrowing incredibly cheap. The result was a surge in consumer demand for everything from cars to houses to electronics. People had cash and credit readily available, and they were ready to spend. But on the supply side, the pandemic had disrupted global supply chains. Factories in Asia were shut down, shipping ports were clogged. The labor force had shrunk due to sickness and the Great Resignation. The combination was explosive. We had unprecedented demand hitting severely limited supply. This imbalance created a perfect environment for demand-pull inflation. It was a classic case of too many dollars chasing too few goods, leading to soaring prices across the board. Cost-push inflation: rising costs force prices upward. The second engine, cost-push inflation, happens when the cost of production rises, forcing producers to increase their prices to maintain profit margins. This can originate from several sources. Supply chain shocks: if a key raw material becomes scarce, its price skyrockets. For example, a global microchip shortage forces car manufacturers to raise prices because the cost of producing each vehicle has increased significantly. Energy prices: energy costs are embedded in nearly every product and service in an economy. The price of oil determines the cost of transportation, manufacturing, and even agriculture. When geopolitical events such as conflicts in oil-producing regions or production cuts by cartels like OPEC cause energy prices to spike, a ripple effect runs through the entire economy. Wage growth: if workers demand and receive significant wage increases, which often happens in tight labor markets where employers must compete fiercely for talent, businesses must raise prices to cover those additional costs. This can lead to a wage price spiral where rising wages lead to higher prices, which in turn leads to demands for even higher wages, creating a dangerous feedback loop. The inflation we've experienced recently in the U.S. is a perfect storm of both demand-pull and cost-push factors. The initial demand surge from stimulus collided with supply chain disruptions from lockdowns and later energy shocks resulting from geopolitical conflicts. The confluence of these two forces created the highest inflation levels seen in the U.S. for decades. The illusion of the American dream in an inflationary environment. When inflation is high, the American dream of saving for the future becomes an illusion. Let's look at a concrete example. Imagine you have $100,000 in a savings account earning a generous 4% annual interest. If inflation is running at 7%, your purchasing power has effectively decreased by 3% in that year. You have more dollars in your account, but those dollars buy less. Over time, this erosion compounds. If a 7% inflation rate persists for a decade, your $100,000 would need to be over $196,000 just to maintain the same purchasing power. If your savings account only earned 4%, you would have only $148,000, a significant loss in real terms. This is why traditional advice about saving money in a bank account is so dangerous during inflationary periods. It's a strategy designed for an era of low, stable inflation, not the volatile environment we face today. The challenge for investors and savers in this new reality is not merely to grow their wealth, but to prevent its silent destruction. Chapter 2: The Federal Reserve's Tightrope Walk, a macroeconomic case study. When we talk about inflation in the United States, we cannot avoid discussing the Federal Reserve. The Fed is arguably the most powerful economic entity in the world. Its actions in response to inflation directly impact every single American household, from the interest rate on your mortgage to the performance of your retirement fund. The Fed operates under a dual mandate established by Congress to maintain maximum employment and stable prices, low inflation. These two goals often conflict. To fight inflation, the Fed's primary tool is to increase interest rates. The mechanism is simple. By raising the federal funds rate, the Fed makes it more expensive for banks to borrow money. Banks, in turn, pass these higher costs on to consumers through higher interest rates on mortgages, car loans, and business loans. The mechanism of tightening. Let's trace the flow of a rate hike. When the Fed raises rates, it increases the cost of capital throughout the economy. Businesses borrow less, invest less, and hire less. Consumers borrow less for big purchases like homes and cars. This reduction in demand helps cool off the economy and reduce price pressures. The goal is to bring demand back in line with supply. The dilemma of the soft landing. The challenge for the Fed is performing a soft landing. This means slowing down economic growth just enough to stop inflation without causing a recession and high unemployment. The historical track record of achieving a soft landing is poor. When inflation has reached high levels in the past, like in the 1970s, the Fed often had to induce a severe recession, a period of high unemployment, to break the back of inflation. Case study: the Powell Pivot 2022 to 2023. The current inflationary period provides a textbook case study in Fed policy and its consequences. When inflation first appeared in 2021, Fed Chair Jerome Powell initially dismissed it as transitory, arguing that the supply chain issues would quickly resolve themselves and prices would normalize. This wait-and-see approach was a costly mistake. By the time the Fed realized inflation was entrenched and required action, it was running hot. The subsequent policy response was aggressive. In 2022, the Fed undertook one of the most rapid and significant rate hiking campaigns in its history. This move had immediate and powerful effects. Housing market shock. The average 30-year fixed mortgage rate skyrocketed from under 3% to over 7% in a matter of months. This effectively priced millions of Americans out of the housing market, causing home sales to plummet. Stock market volatility. Tech and growth stocks, which rely heavily on cheap capital for future growth, saw significant sell-offs. The high-growth, high-multiple stocks that thrived during the low-interest rate environment of the pandemic were suddenly re-evaluated by investors. The global impact of the strong dollar. As the Fed raised rates, U.S. government bonds became more attractive to global investors seeking yield. This increased demand for the US dollar, causing it to strengthen significantly against other currencies. For countries with dollar-denominated debt, a strong dollar makes their loan payments more expensive, potentially triggering crises in emerging markets. The Fed's actions demonstrate a fundamental truth. While we may view inflation as a personal problem, its causes and cures are inextricably linked to macro-level decisions made in Washington, D.C. Understanding the Fed's reaction function, how it will likely respond to economic data, is essential for any investor trying to navigate this landscape. Chapter 3. The Asset Class Showdown: Gold versus Bonds. As traditional hedges for centuries, certain assets have been considered reliable defenses against inflation. Let's compare two of the most popular, gold and Treasury inflation-protected securities. Tips. Gold, the traditional inflation hedge. The barbarous relic gold has held a unique place in human history as a store of value. It has been used as currency, jewelry, and a symbol of wealth for millennia. The argument for gold as an inflation hedge is rooted in its scarcity and its lack of intrinsic link to any specific government or economy. During times of geopolitical uncertainty or high inflation, investors tend to flee paper assets, stocks, and bonds and seek refuge in tangible assets like gold. Arguments for gold: tangible value. Unlike paper currency or digital assets, gold is a physical commodity that cannot be printed by a central bank. Its value is determined by supply and demand for a finite resource. Historical performance: in certain periods of high inflation, like the 1970s, gold experienced massive price appreciation. Between 1971 and 1980, gold prices rose by over 600%, outperforming almost every other asset class. Geopolitical hedge: gold often performs well during periods of political turmoil or conflict, acting as a safe haven when investor confidence in traditional institutions wanes. Arguments against gold: volatility. While gold can rise during inflation, its correlation is not always reliable. Gold prices can be highly volatile based on short-term market sentiment rather than underlying economic fundamentals. No yield: gold does not produce income or cash flow. It is a non-productive asset. The only way to make money from gold is if someone else pays more for it later. This makes it a speculative asset rather than an income-generating investment. The barbarous relic criticism: economists like John Maynard Keynes famously dismissed gold as a barbarous relic because it sits idle without contributing to economic growth or innovation. Tips: the modern, engineered hedge. For those who want a direct, government-backed hedge against inflation, Treasury inflation-protected securities tips are a modern alternative. Tips are U.S. Treasury bonds whose principal value adjusts based on changes in the CPI. How tips work: when you buy a tips bond, the principal amount is protected against inflation. If inflation rises, the principal value of the bond increases accordingly. When the bond matures, you receive the greater of either the adjusted principal or the original principal. The interest payments you receive are based on this adjusted principal. Arguments for tips: direct protection. Tips provide a nearly perfect hedge against inflation. If the CPI rises, your investment directly increases in value. It removes the guesswork and volatility associated with other assets. Safety of principal. Backed by the full faith and credit of the U.S. government, tips are considered extremely safe in terms of default risk. Income generation: unlike gold, tips pay regular interest, providing a steady income stream that adjusts with inflation. Arguments against tips: taxes: you must pay federal income tax on the inflation adjustments to the principal, even though you don't receive this portion in cash until the bond matures. This makes tips potentially inefficient in non-tax-advantaged accounts. Low real yield: the interest rate or coupon rate on tips, often called the real yield, is typically quite low. In periods of disinflation, when inflation slows, tips can underperform traditional bonds. Deflation risk. In a rare deflationary environment when prices fall, the principal of tips can decrease below its original purchase price, although it is protected from falling below its initial face value at maturity. Conclusion on traditional hedges. While both gold and tips offer protection, they serve different purposes. Gold is for investors seeking a speculative, tangible asset that performs well during high volatility, high uncertainty periods. Tips are for investors seeking guaranteed, low volatility protection for a portion of their principal, prioritizing preservation over speculation. The choice depends entirely on the investor's risk tolerance and outlook on future economic stability. Chapter 4: The Housing Market Conundrum. Real estate as an inflation hedge. For many Americans, owning a home represents the pinnacle of financial security and the primary vehicle for building intergenerational wealth. The conventional wisdom holds that real estate is one of the best possible inflation hedges. Let's explore why this is often true and also analyze the significant risks involved in today's market. Arguments for real estate as an inflation hedge. Rising asset values. Real estate prices tend to increase during inflationary periods. This is due to a combination of factors. First, the cost of building new homes increases dramatically when inflation hits because of rising costs for materials: lumber, steel, concrete, and labor. This makes existing homes more valuable. Second, in a high inflation environment, investors flee cash and look for tangible assets, driving up demand for real property. Rental income and leverage. For real estate investors, landlords, inflation often allows for rental price increases, which create a strong hedge against rising operating costs. Furthermore, real estate allows for leverage using debt. If you bought a property with a fixed-rate mortgage, the value of the property rises with inflation, while the value of your debt, the mortgage payments, decreases in real terms. The debt becomes cheaper to pay off with inflated dollars. The mortgage lock-in effect. This is a crucial current factor. When interest rates rise, existing homeowners who are locked in low rates become resistant to selling their homes. They don't want to lose their 3% mortgage and replace it with a 7% mortgage on a new property. This creates a supply shortage in the housing market, keeping prices elevated for available inventory, even as demand from new buyers falls due to higher financing costs. Arguments against real estate as an inflation hedge. Liquidity risk. Real estate is highly illiquid. You cannot sell a house in a day like you can sell stocks. If you need cash quickly, real estate is a poor choice. If you are forced to sell in a falling market often precipitated by high interest rates, you can lose significant capital. Interest rate sensitivity. The biggest risk to real estate as an inflation hedge today is the cost of financing. When the Federal Reserve rapidly raises interest rates, it immediately impacts mortgage rates. High rates can quickly make housing unaffordable for new buyers, potentially crashing demand and leading to a significant price correction. This is precisely what we saw in 2022 and 2023 in many U.S. markets. Local market risk. Real estate is fundamentally a local market. While national trends exist, individual home values depend heavily on local economic factors, job growth, taxes, and demographics. A property in one city may perform well as an inflation hedge, while another property in a different city loses value due to local economic decline. The current housing dilemma. The post-COVID housing market presents a unique paradox. We have high inflation, which should support real estate prices, coupled with high interest rates, which should reduce real estate prices by limiting affordability. The lock-in effect from low pandemic-era mortgages is preventing new inventory from hitting the market, thereby creating an artificial floor under prices. This makes current market conditions especially complex for those trying to enter or exit the housing market as an inflation hedge. Real estate investment strategy. For those considering real estate as an inflation hedge, the focus must shift from flipping houses to long-term ownership with positive cash flow. Buying rental properties, especially multifamily homes where rents can be adjusted, offers a powerful hedge. The key is securing financing with a fixed interest rate. If you can lock in a loan at a rate lower than the long-term inflation rate, you essentially finance your asset with cheap money, allowing inflation to erode the value of your debt while simultaneously increasing the value of your asset. However, for a typical American family saving up to buy their first home, high inflation paired with high interest rates creates a nearly insurmountable barrier. The cost of living makes saving difficult, and the high interest rates make buying unaffordable. In this scenario, real estate acts more like a source of anxiety than a hedge against inflation. Chapter 5: Stocks and the Stock Market. The myth of the automatic inflation hedge. Many investors assume that stocks automatically protect against inflation. The logic is simple. If prices rise, company profits will rise, and therefore stock values will rise. While this holds true for specific companies and sectors, it is a dangerous generalization. Not all stocks are created equal in an inflationary environment. The disparity between growth and value stocks. Inflation tends to create a significant divergence between two main categories of stocks: growth stocks and value stocks. Growth stocks, these are companies where investors pay a premium for high future earnings growth. Think technology companies, high P/E ratios. When inflation rises, central banks increase interest rates to slow demand. Higher interest rates make future earnings less valuable today. A discount rate increase significantly impacts the valuation of growth stocks, which are heavily weighted toward future cash flows. Case study: the tech sell-off. During the 2022 rate hikes, we saw a dramatic sell-off in growth stocks. Companies that relied on cheap capital to finance rapid expansion saw their valuations tumble. The rising cost of capital directly contradicted their high-growth business model. Value stocks. Inflation-resistant sectors. These are companies with stable earnings, strong balance sheets, and consistent dividends. Think energy, materials, utilities, consumer staples. When inflation is high, value companies often have the ability to raise their prices, pass through costs without losing customers. Sectors that excel during inflation: energy and materials. Companies that produce raw materials necessary for the economy are a powerful inflation hedge. As inflation accelerates, the price of oil, natural gas, copper, and lumber typically rises faster than other goods. Companies like ExxonMobil XOM or Chevron CVX benefited tremendously from the post-pandemic energy price spikes. Consumer staples. These are companies that sell non-discretionary items, things consumers must buy regardless of economic conditions, such as food, beverages, and household products. Think Coca-Cola, Procter & Gamble. Because demand remains stable, these companies can often raise prices to offset rising costs without losing significant market share. Financials. Banks and financial institutions often benefit from rising interest rates. The net interest margin, the difference between what they earn on loans and what they pay on deposits, expands, increasing profitability. The importance of active management and diversification. During inflationary periods, a set-it-and-forget-it strategy like simply holding a broad index fund like the S&P 500 can be misleading. While the S&P 500 might eventually recover, its performance during high inflation can be volatile. The key is active management and diversification into inflation-resistant sectors and asset classes. The risk of zombie companies. One often overlooked aspect of inflation and rising rates is the impact on zombie companies, businesses that are unprofitable and only survive because interest rates are near zero. As rates rise, these companies lose access to cheap financing and often default, leading to widespread job losses and volatility in certain market sectors. This is why a simple index fund approach can be risky. It forces you to hold a basket of both robust and fragile companies in the face of economic stress. Chapter 6: The Innovation Bet. Cryptocurrencies and alternative assets. The rise of digital assets, primarily Bitcoin, has introduced a new player into the inflation hedge debate. The core argument for Bitcoin as an inflation hedge rests on its scarcity and decentralized nature. Proponents argue that Bitcoin is digital gold because its supply is absolutely finite, capped at 21 million coins, and no single central bank or government can print more of it, unlike fiat currency. Arguments for crypto as an inflation hedge. Decentralized scarcity. Bitcoin's fixed supply makes it fundamentally resistant to inflation caused by monetary expansion, QE, stimulus spending. In theory, as central banks print more fiat currency, the value of a scarce asset like Bitcoin should rise. Digital gold. The narrative that Bitcoin is a store of value has gained significant traction. High net worth individuals and institutional investors have increasingly allocated a small portion of their portfolios to Bitcoin for this reason, viewing it as a hedge against global currency devaluation. Store of value versus transactional currency. Bitcoin's primary use case in the current economic climate is as a store of value rather than a medium of exchange. Its price volatility makes it impractical for everyday transactions, but its potential to preserve purchasing power over the long term is attractive to a growing number of investors. Arguments against crypto as an inflation hedge. Correlation with tech stocks. During the 2022 rate hike cycle, Bitcoin and other cryptocurrencies often acted less like digital gold and more like high-risk technology stocks. They demonstrated high correlation with the Nasdaq index, meaning when interest rates rose and growth stocks fell, Bitcoin also plummeted. This undermines the argument that crypto is a reliable hedge against monetary policy tightening. Volatility. Cryptocurrencies are extremely volatile. A 20% drop in a single day is not uncommon. While this volatility offers high potential returns, it also poses an existential risk to a savings portfolio. For many investors, protecting savings inherently implies a lower volatility strategy. Regulatory risk. The future of cryptocurrency regulation in the U.S. remains uncertain. Increased regulatory scrutiny, potential capital gains taxes, classification as securities could significantly impact the market and undermine its value proposition as a decentralized, unregulated asset. The conclusion on alternative assets. While crypto shows promise for long-term wealth preservation for those with high risk tolerance, it cannot yet be considered a reliable, low-volatility inflation hedge for the average saver. Its correlation with growth stocks during rate hikes suggests that its current behavior is heavily influenced by the same monetary policy decisions that affect other risk assets. For the average American looking to protect their savings from inflation, allocating a small percentage of a portfolio to crypto might be a speculative bet, but it should not be the primary defense strategy. Chapter 7: Lifestyle Engineering. Adapting Personal Finance in an Inflationary Environment. The strategies we've discussed so far focus largely on investing. But what about the day-to-day choices that define personal finance? When inflation runs high, a new level of diligence and optimization is required simply to maintain your standard of living. This is what I call lifestyle engineering. Debt management. Good debt versus bad debt. One of the most powerful tools in an inflationary environment is debt management. Inflation actually works in favor of those holding fixed-rate debt. Fixed-rate debt. If you have a fixed-rate mortgage at 3% and inflation runs at 7%, you are effectively paying off your loan with dollars that are worth less and less each year. The real cost of the debt diminishes over time. This is why paying off a low-interest fixed mortgage early may actually be a poor financial decision during high inflation. Variable rate debt. This is the opposite. If you have variable rate debt, such as credit card balances or adjustable rate mortgages, your payments will rise as interest rates increase. High inflation typically forces central banks to raise rates, making variable debt significantly more expensive. Therefore, prioritizing the payoff of all high-interest, variable rate debt becomes critical. Income generation. Investing in human capital. When inflation outpaces wage growth, the only way to stay ahead is to increase your income. This requires shifting focus from passive saving to active income generation. The power of side hustles. A side hustle provides an immediate source of additional income that can offset rising living costs. This can range from freelance work to starting a small online business. In an inflationary environment, a high-paying side gig can provide the necessary buffer to maintain your current lifestyle without dipping into savings. Human capital investment. The most significant asset an individual has is their human capital, their ability to earn income. In an inflationary economy, investing in new skills, education, and professional development, human capital often yields a higher return than traditional investments. By increasing your market value, you increase your ability to demand higher wages, thus creating a direct hedge against inflation. Budgeting for inflation. Standard budgeting practices often assume stable prices. In an inflationary environment, budgeting becomes a dynamic process. You must analyze where price increases are hitting hardest and adjust your spending accordingly. Discretionary spending cuts. High inflation requires cutting discretionary spending, not just to save money, but to free up cash flow that can be reallocated to necessities, housing, food, energy, where costs are rising rapidly. The price lock strategy. Look for opportunities to lock in prices. For example, if you know a subscription service or utility company offers a fixed-rate plan, consider locking in a rate before future price increases. Chapter 8. The Global Perspective. Geopolitics and Supply Chain Disruptions. Inflation in the United States is no longer solely an internal matter. It is deeply intertwined with global events and supply chain dynamics. In the modern, interconnected world, a geopolitical shock in one region can send price ripples across the globe. The Ukraine war and energy shock. The conflict in Ukraine provides a stark illustration of how geopolitics directly fuels inflation in Western economies. Russia's role as a major energy supplier, oil and natural gas, means that sanctions and disruptions in supply directly impact global energy prices. Energy and food prices. The conflict caused a dramatic spike in energy prices across Europe and the U.S. This is a classic example of cost-push inflation. Furthermore, Ukraine is a major global supplier of grains, wheat, and sunflower oil. The disruption of grain exports contributed to global food price inflation, directly impacting consumer costs at the grocery store. No pro-Russian propaganda. It is important to analyze this event purely from an economic perspective. The supply disruption caused by the conflict has created a significant inflationary pressure point for Western economies, forcing central banks to react to externally driven cost increases in addition to domestic demand pressures. The globalization backlash and supply chain resilience. For decades, companies maximized profits by seeking the lowest cost labor and materials globally, just-in-time inventory systems. This globalization created efficiency but also extreme fragility. When the pandemic hit, supply chains broke down. Companies were suddenly unable to get microchips from Asia or goods from overseas factories. Shifting to reshoring and friendshoring, the inflationary period has highlighted the risk of relying on long, complex global supply chains. Companies are now beginning to reshoring, bringing manufacturing back to the U.S. or friendshoring, sourcing from geopolitically aligned countries. While this increases supply chain resilience, it also increases initial production costs, potentially sustaining a higher baseline level of inflation compared to the pre-COVID era. The strong dollar's impact on emerging markets. As discussed in Chapter 2, a strong U.S. dollar, driven by high interest rates, creates significant problems for emerging markets. Many developing countries hold debt denominated in U.S. dollars. When the dollar strengthens, their debt payments effectively increase. This can lead to financial instability, currency crises, and, in some cases, defaults, further fueling global economic uncertainty and potentially impacting commodity prices. This interconnectedness means that protecting your savings from inflation now requires a global perspective. The risks are no longer purely domestic, they are tied to geopolitical stability and the resilience of global supply chains. Chapter 9: The Historical Perspective: Lessons from the 1970s Stagflation Crisis. To truly understand the current situation, we must look back at a previous period of high inflation in the U.S., the 1970s. This decade was defined by a phenomenon called stagflation, the simultaneous occurrence of high inflation and high unemployment, economic stagnation. This period offers crucial lessons on how to protect wealth when traditional economic models fail. The roots of stagflation in the 1970s was caused by a similar combination of factors we see today: high demand and supply shocks. The U.S. government spent heavily on both the Vietnam War and social programs, leading to excessive demand. This was followed by two major oil crises, 1973 and 1979, where OPEC dramatically cut production, causing massive cost-push inflation. The Volcker shock: the crisis reached its peak when Paul Volcker became chairman of the Federal Reserve in 1979. He recognized that previous attempts to control inflation through modest rate hikes had failed. Inflation had become entrenched in the public psyche. People expected prices to rise, leading to a self-fulfilling prophecy where businesses raised prices in anticipation of future cost increases. Volcker's solution was drastic. He implemented extremely aggressive interest rate hikes, pushing the federal funds rate above 18% at one point. This led to a severe recession, with unemployment peaking around 10%. However, the policy worked. It successfully broke the back of inflation and re-anchored inflationary expectations. Lessons for today's investor: patience and persistence. The 1970s demonstrate that fighting high inflation requires persistence and often involves significant economic pain. The Federal Reserve cannot simply wish inflation away. It must take decisive action, even if unpopular. Asset performance during stagflation. During the 1970s, traditional assets like stocks performed poorly. The S&P 500 stagnated for much of the decade. Real estate, however, performed exceptionally well. Gold also experienced massive growth, as discussed in Chapter 3. The key takeaway is that during periods of high inflation, tangible assets and commodities often outperform financial assets. Debt reduction and fixed rates. The 1970s highlighted the importance of fixed interest rates. Those who held fixed-rate mortgages saw their debt diminish in real value as inflation surged. Those who had high variable-rate debt faced rapidly rising payment costs. Comparing today to the 1970s, while there are striking similarities, there are also key differences. Today's economy is highly reliant on services and technology, not just manufacturing and energy. The speed of information and global trade is vastly different. However, the core lessons remain. Inflation requires proactive measures, a focus on tangible assets, and an understanding of how monetary policy will impact different sectors of the economy. Chapter 10: The Big Picture: Reevaluating the American Dream in an Inflationary Era. Let's synthesize everything we've discussed and connect it back to the core idea of the American Dream. The American Dream traditionally implied a pathway to upward mobility, education, a stable job, home ownership, and a comfortable retirement. Inflation directly challenges every single one of these pillars. The erosion of savings and retirement. The most immediate threat from inflation is retirement savings. For decades, Americans were told to put money into 401ks and index funds. The assumption was that compound interest would make them wealthy. But if inflation persistently outpaces returns, a significant portion of that wealth building is wiped